when the stock market is volatile, you feel like you should be doing something. You are hardworking. You are proactive. You're not a quitter. I should do something. But what is it? Because I don't want to mess this whole thing up by meddling. I feel like that's how most smart investors are. It's like, I want to be proactive, but I don't want to mess this whole thing up,
Right.
Especially if you are at the phase of life where you're reaching out to somebody like Mike Douglas. You're close to retirement or you've just retired and you want to make sure that you're going to be good for these retirement years. Well, we got to ask Mike how to manage all the volatility that we've been seeing as of late. As of this time, we're recording this podcast on March 31st, 2025. It seems like week in, week out, just depending on what the president talks about as far as tariffs or wanting to take over Greenland or what. And this is not a political conversation. This is just what we're seeing happen in the markets reaction. So I'm Heather Branch. This is certified financial planner, Mike Douglas, Michigan's retirement coach, here to help us understand. Probably safe to say, though, when it comes to the market, is there really any understanding? If we're being honest with ourselves.
It's a lot. Right now, there's a very interesting thing. There's a couple things, and I'm going to nerd out a little bit because it's what I love to do.
You love nerding out.
There's two things going on. There's a major tech pullback, which we were due for, and then there's also President Trump stuff. So it's like you got two things happening at one time, and both are having a negative effect on the market. Mm-hmm. The one needed to happen, and it's a good reset. The other one, we'll see.
Okay. Well, when it comes to some to-do items, because that's the thing I'm always asking you on this podcast. It's like, okay, let's give listeners to-do items, action items, steps they can take when there is volatility in the market and you want to be doing something, but you're not sure what. Carrie Hannon, when she was on Yahoo Finance talking about a few easy steps to follow, here's what she said.
So the first thing, number one, I tell people and all the advisors I've spoken to today, sit on your hands a little bit. Wait before you make any big emotional moves, okay? Number two, it's important to stay in equities, no matter how close you are to retirement. This is where your growth is going to continue to come from. That said, the older you are and the closer you are to retirement, you need to shift a bit into, some cash equivalents or some great fixed income opportunities. We're just at the beginning of what I would anticipate to be a few years of volatility. And so periodically you should be rebalancing anyway, but this might be a good time to have that conversation.
She's calling us out a little bit. At the very end there, she slid it in. You should be rebalancing periodically anyway. It's like, well, dang, Carrie, we didn't need to hear the obvious.
Right.
But, I mean, she
also
made
said,
several points there.
Regardless of your age, you should be staying in equities. Unless you're closer to retirement. I'm like, that's regarding age.
Okay, so got some mixed messages there.
Yeah.
So
come on, Carrie.
Come on, Carrie. Let's trash the person who's not here to defend themselves.
Yeah, that's right. Yahoo Finance.
But obviously some actionable items there. What do you think about her advice? Would you add to the list? Let's break, again, action steps. Let's break things down a little bit.
Yeah. I think that there's really 5 key things that we should be looking at to make good decisions during volatile times.
Okay.
The first one, stay focused on the long-term plan. Okay. Don't jump to the end. There's no shortcutting in this line. You have a long-term vision of what you want your life to look like and where you want it to go and where you want your finances to be. Now, for some people that may be, I want to retire in 4 years, 10 years, 12, 15, 20 years, whatever the number is. And so as a result, I need these actions along the way to get me there. And I always use this example, but whenever we go on the road trips, when we go out east to visit my family, we just went down to Missouri a couple weeks ago and we drove, and you just put the destination in your GPS. You don't put your location, you put the destination. Mm-hmm. And then your GPS sees where you are, it sees where you want to go, and it maps out the best way to get there. Then as you're going, you get these alerts, updates. We're going to go a different route because I saved you 7 minutes, or we need to change because there's traffic ahead or construction. And these updates will tweak the plan to get you to the destination you want. It doesn't drastically change the plan. If you're going, it's kind of like the thing, if I'm going from Michigan to Delaware, at worst, I know go east, right? Like just
right.
I don't if a road
don't
says
go west,
I don't go on that road.
Yeah. Okay.
Right. So like that part we at least can know. And so there's basic concepts that we need to keep sticking to. Mm-hmm. And when you are having a long-term vision, it helps you make better short-term decisions. Mm-hmm. Look at the end and make your short-term decisions in line with that. So first thing, stay focused on the long-term plan. Number 2, review your withdrawal strategy. If you're taking money out of your accounts and the market starts going bad, that can be a volatile time because now the market's dropping and I'm taking from a depreciated asset, I'm taking money out. So the market lost me money and then I took money. So if I'm pulling 4% out per year and the market's down 10%, well, now I'm down 14%. And then next year, when I go to take 4% out, do I take 4% of a lower number so I get less income? Or do I take the same dollars, which is now 5 or 6%, and it hurts my portfolio a little more? So there's decisions we have to make on withdrawals. Also, the taxation of the withdrawals at this phase of the game. You know what? If the market's down and I pull from my IRAs because I'm in retirement and I have to pull more because I have to take out taxes, it actually can increase some of that risk. And so that's versus if you have non-qualified money or Roth money, there's some different decisions there. So just review your withdrawal strategy and make sure it's current, and that it still fits how you may need to tweak it in a volatile time. Number 3, assess your risk exposure. The market is what the market is. It's going to be volatile. There's going to be good years that are going to be great, and there's going to be bad years that are bad. That's the definition of volatility, because volatility goes 2 ways. We always think of, the market's volatile, it's losing me money.
That's a good point.
But
we
the
put the
market
negative
also is
connotation
volatile
on it.
and
Yeah.
makes you money, right?
Yeah.
And that's the other side of it. Like a volatile market makes people money big time. But it can be volatile like this, like it goes up and then it drops, and it goes up higher, then it drops. And that's really the last 7-8 years in the market. Great growth, major pullback, great growth, and that's been regardless of administration. It happened in 15, it happened in 18, it happened in 2020, it happened in 2022, and now it's happening at the start of this year. So we see growth, pullback. That's volatility. Just understand if you're okay with it or not. So at different phases of life, as Carrie said, she says, well, regardless, you should have equities. I do agree with that. You should probably have some money in the stock portion of the stock market.
Okay.
But at the same time, you may want to start pivoting towards a less risky position the older you get. Maybe I need some cash alternatives, some fixed income, an annuity, or something that makes sense for you at this phase of life. How do I de-risk the portfolio while still accomplishing my long-term goals? So understanding at this phase of life, are you okay with the amount of risk exposure you have? Because to try and time it out and say, well, I want to be risky when it's good and really, really safe when it's bad, don't try to catch a falling knife. Don't do that. Just have your money in like these pots and just say, this pot can go be risky. This pot can't anymore. Now, if you're younger, all chips
it's a different story. Yeah.
All chips in. Diversify by having different fast growing assets, but stay all in. If you are in retirement, you start saying, hold on a second, I cannot lose 30% of my portfolio. I'm not okay with that. So as a result, we have to really de-risk this thing. Okay, great. Different build. So that's just kind of the model that you need to make sure. Understand your risk exposure.
Okay.
So number 1, long-term planning. Number 2, address your withdrawals. Number 3, assess your risk exposure. Number 4, diversify the right way for now. Right. And I kind of just hinted at this in the last one, but diversify in a way that makes sense for who you are today. If you're 20, 25, 30, 35, diversify by getting as many fast growing blue chip stuff as you can get, or high risk, high tech stocks. Get all the stuff. Go all the way in and let it run, because over the next 20 to 30 years, it's going to do you a lot of favors, more good than bad. If you are in retirement or near retirement, you diversify by saying, I'm taking some of the chips off the table, and I'm going to go into a fixed income or a cash or an annuity or something like that that really helps protect and give you the income you want the rest of your life without being exposed to the market. We don't want our retirement income to be subject to market losses. We want our portfolio to be subject to gains and some loss, but not income. So it's about diversifying that way.
Okay.
The last thing, avoid panic selling and market timing. That's the catching the fallen knife we just talked about. We talked about this before, the Amazon cart rule. If you have an Amazon shopping cart and you put something into it, you should make yourself wait 24 to 48 hours before you buy it. Now, unless this is like an absolute, like,
I need this right. I need I'm out of toothpaste, and I'm thinking about it right now. Add to cart, can be delivered by tomorrow or whatever. Fine.
And that's not what we're talking about. We all know what we're talking about here. it's 11:30 at night, and you're just, on your phone or whatever else, and then you
Doom
see
scrolling.
something, and you're just like, ooh,
I
that
need
could be
it.
cool.
I need
That could be
it.
good.
Give
And you
me
throw it in your
it.
cart.
Yes.
Now, if I had asked you an hour prior, do you need this thing? You would have probably said no.
You probably would, maybe you wouldn't even know, what is it? What are you
Yeah, what
talking
is that
about? You
thing?
didn't even know it
Yeah.
existed. You
Heated
know what?
gloves.
I respect the Amazon and all the websites that do this. Like, if you push purchase in the next 5 minutes, you can have it by tomorrow. You know that time that time panic thing that they do. I mean, I
That's
respect
such good
them
marketing.
as a marketing professional. I respect them.
Oh, yeah.
But as a consumer, I'm like, hey man, back off.
Don't put baby in a corner. No, exactly. Like, don't give me the option to know that when I wake up, this is gonna be sitting on my porch.
Yes.
Get out of here.
Get out of here.
And so exercise like a 24 or 48 hour Amazon cart rule. Why? Because it seems like a good idea right now, but we were joking before. At 11:30 at night, 2 places you don't want to be:
The kitchen.
on Amazon or in the kitchen.
I know.
No good decisions get made. There's zero willpower at that part of the day. So you don't want to do that. You want to make your decisions early on when you're real strong. And so,
so true.
if that's what we do for Amazon, think about your investments the same way.
Mm-hmm.
Bad news hits. I'm not talking like 9/11 bad news or
Right.
like real issues where you're like, this is a catastrophic thing that's going to tank the market. I have to protect and make a move. Okay,
Right.
That's different.
Right.
I'm talking like, we're going to tariff New Zealand, right? And that's a new one. I've not heard that one yet, so I'm floating it out there.
That's
right?
just
But
this is not happening.
could happen.
We're just saying.
Right? And so, so let's say that's what we're going to do. And the market dips 2%. And you say, I want out. Hold on. Nope. 48 hours. See what happens. See what comes of it.
Okay.
We want to have a slow to react to news model. So in the same way that we need to be slow to purchase on Amazon with the impulse buys,
Yeah.
we need to be slow to sell out of our portfolio just because of news. Because we've seen this even in the past 3 or 4 weeks where some bad news comes out and it tanks for a week. And you go, oh, here comes the crash. And then 4 straight days of good market.
Yeah.
And then here comes the crash. And then 3 straight days. And so when any new administration comes in, if it's not business as usual, if you have a complete change of ideology, there will be choppy times.
Right.
And then typically within a quarter or two, it seems to work itself out that it's either good or bad. So right now, with having the tech companies pulling back, and with having a lot of new policy and a lot of administrative change and a really new ideology going on, as a result, be patient. Let's see what happens with it, and let's see where it goes. Because the thing about equities, and equities just meaning stocks, not bonds or fixed income, but true stock positions in your portfolio, those are the best winners you can possibly own most of the time. But to pick the right one can be challenging. To have the portfolio built the way that makes the most sense for right now can be challenging. And I just understand where you are. So again, long-term planning, review your withdrawal strategies, assess your risk and know what you're okay with, diversify for who you are today, and lastly, 48-hour cart rule on your stocks and your investments, right? We want to be patient. Don't market time.
Panic selling.
Don't panic sell. Have a long-term view. We have the destination, our GPS. It's a certain life. Now, we may have to make small pivots, but I'm not talking about going west to go to Delaware. I'm talking about staying on course with small adjustments. So those things all partner together. Those 5 areas really give you a well-rounded plan, and it helps protect you from the news cycle, from the iPhone stock list where you open your app and it says, oh, all red or all green, and you go into a panic mode. Just stay the course and stay part of it.
Of course, having a plan in place, one that you are reviewing regularly, as Carrie Hannon was so eloquently pointing fingers. I feel like a finger was pointing right at me. I do. I need to get better about it. But when it comes to having a plan in place, when it comes to having somebody by your side to run things by, I think that's another huge asset that you might offer to the folks you work with when they feel like when they want to hit that panic sell button, they can call you and be like, I want to hit the panic sell button. And you can say, whoa. Let's think this through.
Let's go for a walk.
Let's go for a walk.
Let's go for a walk. Sorry. Walk it off.
That's right. Gotta shake it off.
Mhm.
When it comes to keeping your cool with your investments, particularly for your retirement, Mike and his team are here to help you do just that. You can begin the conversation. Find us anytime at michigansretirementcoach.com. We also have links posted in the show notes, so you can just click there. Or again, it's michigansretirementcoach.com.